us now is Vance Ginn, the president of Ginn Economic Consulting and senior fellow at Young Americans for Liberty. Thank you for making the time today, Vance.
It's a pleasure to be with you today.
The CEO of JP Morgan said the U.S. banking crisis is not over and that it will linger for years and that America is moving into a vicious cycle. Do you agree with this? And how do you see this happening here? I mean, can it be fixed?
You know, I think Jamie Dimon is onto something here. We saw a number of years of very low interest rates, a lot of liquidity that was put into the marketplace by the Federal Reserve, a lot of excess spending by Congress, increasing the national debt to over $31 trillion. That puts a lot of Treasury securities debt into the marketplace. The Fed bought, increasing supply of liquidity into the marketplace, and that went into a lot of banks. And those banks were taking riskier and riskier investments to get a higher rate of return. And as you take those riskier investments, what it does is it creates what's a quote unquote boom period, but you're going to have a bust. And so we've got to understand the boom period before we understand the bust. And so I think as a lot of this clears out of the marketplace, a lot of these banks will see more bank failures, as we saw in Silicon Valley Bank, Signature Bank, and some others. I think we'll see more of that. And so unfortunately, there probably will be a prolonged period of economic slow growth, but also even a recessionary period that will be pretty deep and hit a lot of Americans pretty hard, given we'll have higher inflation and fewer jobs in the marketplace.
Yes, there's an action-reaction going on here. Now, over $2 billion were withdrawn from U.S. domestic banks in the 2 weeks after SVB's collapse. Can you tell us about the scale of this compared to total deposits and the meaning there, and what it means for lending, especially small businesses, amid fears of a credit crunch?
Well, you know, that part was just a pretty small portion of the trillions of dollars that are in the overall banking sector. But what it does indicate to me is that there is some fear. There's this risk tolerance of maybe they don't want to take as much risk of putting money in banks. And so people are saying, you know what, let me take my deposits out, put them elsewhere. And, you know, we have the Treasury, the Fed, and the FDIC kind of working together to backstop, really support a lot of those deposits to make sure that all the depositors are going to get their money back, whether it's $250,000 or even more. And so that can create even more risk that banks will take because, look, the banks, ultimately the taxpayer, the government, right, is going to be backstopping a lot of that. And that means that they'll take more risk because they don't have the same amount of risk tolerance that they once did before. And what it also shows is that a lot of the bigger banks are the ones that the government has said they're going to essentially bail out. So you're taking a lot of money from the smaller banks, the regional banks, and giving them to the bigger banks. So you kind of see a swap of where those dollars are going to be held based on what the government is telling you of what they're going to backstop and make sure that they basically bail out a lot of these bigger banks.
Some of the pros and cons of that backstop. Now, what do Americans need to know right now? Do they need to be double-checking their accounts, diversifying, or watching out for scammers?
No, I think that's a great point. I mean, I think that's something that we as Americans always should look at is diversifying our portfolio of assets, whether it be stocks, bonds, in this case, deposits at different banks. I mean, look, the FDIC for a number of years now, since the financial crisis, the Great Recession in the 2000s, has backstopped $250,000, insured up to $250,000 of your deposits. So if you have less than that, which most Americans have well below $250,000 in deposits, if you have more than that, though, then you should diversify, put money in different places. What we saw at Silicon Valley Bank, though, is some of these were small businesses, a lot of technology firms that put millions of dollars into Silicon Valley Bank, and so a lot of that was going to be lost. That was going to be above that $250,000 FDIC insured amount on deposits, and that's where you saw a lot of the hit that was going to take. And look, another thing we need to look at is a lot of the banking sector is doing a lot of the environmental social governance, ESG, which doesn't have good rates of return, and a lot of that's coming to bite them. Not only from the ESG sort of poor investments, like I would say, but also the amount of investments that they were, or amount that they had in Treasury securities, the debt from the government. Whenever those prices of those bonds went down, that decreased the value of their assets, of these balance sheets of the banks, which created a lot of this banking crisis now.
Vance Ginn, president of Ginn Economic Consulting, you've given us a lot to think about. I appreciate it.
Thank you.